Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 8th of November 2019. And earlier today we produced a video entitled Gold Demand Up Thanks to ETFs. Now if you haven't already listened to it, we've placed a link in the description box below. Now this second video podcast is based on an article written by Ben Kumar, who is an investment strategist at 7IM, which is 7 Investment Management, located in London. With stock markets, and especially the US markets, reaching all-time highs, and likely to continue to do so, we thought it important to cover what someone should look out for when investing in equities, how to diversify their equity portfolio, and also we give a hint as to why US stocks in particular seem to do so well when investors invest in global funds. So let's listen to the article. Are your assets truly diversified? By Ben Kumar, investment strategist at 7IM. Investors know the mantra, diversification makes sense. Do not put all your eggs in one basket. It is excellent advice, even though no one buys basket of eggs anymore. The example still works. When it comes to investment diversification, another idiom also comes to mind. Always make sure to look under the bonnet, as what you find may not be what you were expecting. Let us look at global equity investing, for example. There are lots of ways to invest globally. The MSCI World Index includes more than 1,600 companies. This sounds sensible. You're investing in shares all over the world. How much more diversified can you get? However, when you look a little closer, you can find that names can be misleading. The MSCI World Index only covers developed markets. Only 23 countries are represented out of 195 in existence. The index contains no Chinese, Indian, Brazilian, South African, or any other emerging market companies at all. The global index that does include emerging markets is the less snappily titled MSCI ACWI, All Countries World Index. So is this the basket you want? Well, while the MSCI ACWI covers a great deal of the world's economy, it still does not include every single country, despite its name. Many of the 195 nations do not have investable markets, but it does contain 50 of the biggest, including China and India, as well as Egypt, Pakistan, and Qatar, among others. So the emerging markets are represented. But this is not as much as you might expect. If you want to invest globally, common sense suggests that you allocate your investments roughly according to size. The US is the largest economy in the world, making up 1/4 of global GDP, so would need a decent chunk of your investment. China and Europe, excluding the United Kingdom, are each around 1/6 of the total. Their allocation should probably be a bit smaller than the United States, but still substantial. When you take a closer look under the bonnet of the MSCI ACWI, though, you find that the coverage is quite different to what common sense might suggest. More than 55% of the index is invested in United States companies, more than twice its share of the global economy. European companies are around 12% of the index, compared to nearly 20% of global GDP. The biggest difference is China. The second largest economy in the world makes up just 4% of companies' weight in the All Countries World Index. Now, in this index, you are hugely focused on the US, with little exposure in other parts of the world that are doing well, such as China. US President Donald Trump might like the sound of this portfolio, But is it what you expected? And more importantly, is it sensible? The other area we would encourage investors to examine closer is not just where a company is based, but where it does business. Just because BP, British Petroleum, has its headquarters in London, that does not mean it only sells oil in Britain. Apple might be American, but iPhones are a global phenomenon. One way to look at this is to break down the sales exposure of the companies in the MSCI ACWI. Where do they actually make their money? This will show us the amount of sales that the companies listed in a country make from their home market. Some equity markets, such as the United Kingdom, are very global, whereas others, such as China or Japan, are far more domestic. The UK has lots of global companies listed there for the London postcode. Some have little or nothing to do with the UK economy. In fact, only 20% of the sales of UK listed businesses actually come from this country. With China, the opposite is true. More than 88% of Chinese company sales are in mainland China. With 1.2 billion potential buyers, perhaps that is no surprise. European companies are evenly split, with half of sales internal. Meanwhile, the United States story is very similar to China, with 75% of company sales inside its own borders. Breaking the ACWI down in this way, by sales rather than country of listing, can help balance things out a little. Europe accounts for almost the same share of global sales as it does of the global economy, and China becomes a little better represented, rising to 9% of the total exposure. However, even when taking this approach, the US still dominates. If you have a lot of US companies, you will have a lot of US exposure. Even on a sales basis, the US is still 50% of the portfolio, double its share of the global economy. What this shows is that it is not enough to just have your eggs in different baskets. The financial world is not always as sensible as the egg-carrying world. We believe that to achieve true diversification, you need to dare to be different. You should allocate investments in proportions closer to the economic world rather than the way the financial world portrays it. The key points we can conclude from this are: 1. Diversification is important in investments. 2. The MSCI ACWI does not cover every country. 3. One should allocate investments in proportion to the economic world. And 4. US stocks consistently appear to gain an advantage in global funds, which may account, to some degree, the additional impetus US equity markets get, sometimes even by accident. Now, whilst we accept the fact that many of our listeners may not invest directly in equities, we know that a number do, and also a number have pension funds and other investable assets in global funds. So it's important to be aware of these differences. And we hope that this article, published in Financial Advisor this week, helps to illuminate a little as to what to watch out for when equity investing with a view to global diversification. Thank you for listening, and please do not forget to join us tomorrow when we shall produce our weekly gold and silver update. As you may have noticed, there has been some movement in the price of gold and silver this week, and we shall cover this in some depth tomorrow. Meanwhile, if you haven't already done so, please subscribe to this channel and press the bell sign so that you're notified as soon as our latest video is published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, Please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.